What if the most powerful company in America is not Apple, Amazon, Tesla, or even the US government? What if it is a company most people could walk past without recognizing? Its name is BlackRock, and its influence reaches into your retirement account, your favorite companies, the housing market, and global politics. It even reaches into the decisions made during America's biggest financial crises. But does BlackRock really own everything? Or is the truth even more complicated? In recent years, a simple viral claim has spread across social media. Millions of people have repeated it, that BlackRock owns everything, that it secretly controls governments and corporations, even the housing and food markets ordinary families depend on. Some of what fuels that claim is real, documented, and genuinely worth understanding, but some of it is exaggeration, misunderstanding, or outright fabrication. This documentary exists to separate the two, using verified facts, court filings, and regulatory records, clearly distinguishing what has been proven from what remains an allegation, and what is simply speculation dressed up as fact. BlackRock's origin story begins, somewhat ironically, with a failure. In 1986, a young bond trader named Larry Fink worked at the investment bank First Boston. There, he oversaw a trade that lost the firm close to $100 million. His team had misjudged how shifting interest rates would affect mortgage-backed securities. Fink has spoken openly about how that loss reshaped his entire professional philosophy. It convinced him that the greatest danger in finance was not poor investment picks. It was the inability to properly measure and understand risk. In 1988, Fink co-founded BlackRock alongside 7 partners. At first, they operated out of a single room inside the offices of the Blackstone Group. Their founding mission was built around rigorous, technology-driven risk management, not the relationship-based, gut instinct style of investing that dominated Wall Street at the time. The firm grew quickly. By 1991, it was managing roughly $9 billion. In 1992, it separated from Blackstone and adopted the name BlackRock outright. In 1999, BlackRock went public on the New York Stock Exchange. By then, its assets under management were already above $165 billion. 2 acquisitions transformed the company into something far larger than a bond shop. The first was the 2006 merger with Merrill Lynch Investment Managers. The second was the 2009 acquisition of Barclays Global Investors. That deal brought with it a suite of exchange-traded funds under a brand called iShares. This acquisition is arguably the single most important event in BlackRock's history, because it placed the company at the center of the passive investing revolution. Trillions of dollars were shifting away from expensive, actively managed mutual funds, and into low-cost index funds that simply tracked the broader market. As of the first quarter of 2026, BlackRock manages approximately $13.9 trillion in assets. That figure comes from the company's own quarterly filings with the Securities and Exchange Commission. It makes BlackRock the largest asset manager in the world, by a considerable margin. Underneath all of this sits a piece of technology most people outside finance have never heard of. It is called Aladdin. That name stands for Asset, Liability, Debt, and Derivative Investment Network. Aladdin was born directly out of Larry Fink's obsession with risk measurement. It was first built in the early 1990s as an internal tool. Its purpose was to give BlackRock's portfolio managers a real-time, unified view of risk, a clear picture of exactly how much risk sat inside their holdings. But what makes Aladdin genuinely significant is what happened next. BlackRock eventually began licensing the system to outside institutions, including some of its own competitors. Today, Aladdin does not just power BlackRock's own trading and risk analysis. It is used by pension funds, insurance companies, sovereign wealth funds, and other asset managers, all around the world. Industry estimates suggest Aladdin processes data on a combined pool of roughly $20 trillion in assets. That includes BlackRock's own holdings, and the holdings of outside clients using the platform. This is an important and factually verifiable distinction, but it often gets lost in popular commentary about the company. Aladdin gives BlackRock visibility into risk data across an enormous slice of the global financial system. That is a legitimate and well-documented source of influence. But visibility into risk data is not the same thing as ownership, and it is not the same thing as direct control over those assets. That distinction matters, and we will return to it throughout this film. To understand why BlackRock appears as a major shareholder in so many large public companies, you need one key distinction: the difference between BlackRock's own money and its clients' money. This distinction sits at the center of nearly every controversy surrounding the company. The overwhelming majority of the $13.9 trillion BlackRock manages does not belong to BlackRock, and it does not belong to Larry Fink. It belongs to teachers, firefighters, retirees, university endowments, insurance companies, and governments, clients who have hired BlackRock to invest money on their behalf. Institutional clients make up roughly 80% of BlackRock's total assets under management. That includes pension funds, endowments, insurers, and sovereign wealth funds. When an ordinary investor buys shares of an iShares ETF, BlackRock follows the fund's strategy. For example, an ETF that tracks the S&P 500 buys the companies inside that index. When a pension fund hires BlackRock, the same basic principle applies. BlackRock uses client money to purchase small slices of hundreds or thousands of companies, exactly as instructed by the fund's stated investment strategy. BlackRock earns a management fee for providing this service, usually a small percentage of the assets it oversees, but the underlying stocks and bonds remain the property of the clients. Legally and functionally, they do not belong to BlackRock itself. This is why BlackRock appears as a top shareholder in thousands of companies at the same time. It is not because BlackRock personally chose to buy massive stakes everywhere. It is not simply a grand strategic plan to own Apple, ExxonMobil, or every major corporation. It is because millions of retirement accounts and pension funds are investing in broad market funds. Each investor is making an individual or institutional decision, but together those decisions create an enormous pool of capital, and BlackRock happens to administer that capital. This structure creates one of the most important features of modern finance: shareholder voting power. When BlackRock holds shares on behalf of its clients, it often holds the legal right to vote those shares. Those votes matter. They can help elect board members, approve executive pay packages, and decide shareholder proposals. Those proposals can cover climate policy, corporate governance, workplace diversity, and other major issues. Because BlackRock aggregates the voting power of millions of mostly passive investors, its voice becomes enormous. Historically, it has cast some of the largest shareholder votes in corporate America. That influence is separate from simple stock ownership, and in some ways, it may be even more significant. In recent years, BlackRock has taken steps to return more voting power to underlying investors. It has launched programs allowing certain institutional clients to vote their proportional shares directly. Some retail clients have also gained more voting choice, instead of BlackRock voting by default on their behalf. This shift came partly in response to years of criticism over how concentrated that voting influence had become. Because even when BlackRock does not own the money, it can still influence how that money votes. And in modern capitalism, voting power can be power of its own. Understanding this basic architecture is essential. Index funds pool money from millions of separate investors. And that structure explains where BlackRock's actual power comes from. Because its power does not come from one single source. It comes from several distinct sources. And they need to be separated clearly. The first and most straightforward source is simple scale. When you administer nearly $14 trillion, even routine investment decisions can move markets. They can shape which companies receive cheap and abundant capital, and which companies struggle to attract it. The second source is proxy voting influence. BlackRock can cast enormous blocks of shareholder votes. Those votes can meaningfully affect corporate governance. They can influence executive compensation, and at times they can shape corporate strategy, including strategy on climate, labor, and social issues. The third source is Aladdin's central role in global risk management infrastructure. That system gives BlackRock uniquely detailed visibility into the health of the broader financial system. The fourth source may be the most consequential. BlackRock has direct relationships with governments and central banks during moments of crisis. During the 2008 financial crisis, the Federal Reserve hired BlackRock. Its job was to help manage and value toxic mortgage assets the Fed had taken on from Bear Stearns and AIG. That role was built directly on Aladdin's trusted reputation for risk analytics. Then, during the 2020 COVID-19 market panic, the Federal Reserve turned to BlackRock again. This time, the firm helped design and execute emergency corporate bond purchasing programs. Those programs were intended to stabilize credit markets. But the contract drew significant public and congressional scrutiny because it placed a private for-profit company in an unusually powerful position. BlackRock was helping implement U.S. monetary policy. At the same time, it continued managing investments in some companies whose bonds the government was buying. Critics questioned whether this created a real conflict of interest. Some of those critics were sitting members of Congress at the time. BlackRock and the Federal Reserve maintained that safeguards were in place, including information barriers between BlackRock's public sector consulting work and private asset management business. This is a documented and verified controversy. It is distinct from more speculative claims about the company, and it remains a legitimate debate among economists and policy analysts. How much operational power should a private financial firm hold during a government-led crisis response? Now let's turn to the criticisms and controversies surrounding BlackRock, because this is what made it one of the most politically contested companies in America. There are several debates happening at the same time, and public discussion often confuses them with one another. The first is called the common ownership debate. This is a serious academic argument, not a fringe theory. It asks whether BlackRock, Vanguard, and State Street holding large stakes across the same industries creates a problem. Airlines, banks, pharmaceutical companies, and other sectors all share this pattern. The concern is that shared ownership might reduce competition. If the same giant asset managers benefit from several companies in the same industry, incentives can change. Companies may feel less pressure to compete aggressively on price because much of their shared ownership base benefits either way. Several published academic studies have found patterns consistent with this theory, especially research examining the airline industry. But other economists dispute those findings. Some argue there are alternative explanations for the same data. So this remains an unresolved question, an actively debated question, and a mainstream economics question, not a settled fact in either direction. The second major controversy involves ESG investing. ESG stands for Environmental, Social, and Governance Factors. BlackRock embraced this approach enthusiastically starting around 2018. That was when Larry Fink began publishing widely read annual letters to corporate CEOs. In those letters, he argued that companies needed to consider climate risk and broader social impact, alongside pure profit. But this drew fierce criticism from two very different directions at the same time. From the political right, Republican state officials and attorneys general accused BlackRock of overreach. They argued that BlackRock was using its enormous shareholder voting power to impose an agenda, a political and environmental agenda. One, they said, lacked a clear mandate from ordinary investors whose retirement money BlackRock was managing. Critics argued this could come at the expense of maximizing financial returns. Texas placed BlackRock on a restricted list in 2022. That happened under a state law targeting companies perceived as boycotting the fossil fuel industry. Florida's state government made a major move in December of 2022. It announced it would pull roughly $2 billion out of BlackRock-managed funds, specifically over ESG-related concerns. Indiana's state pension system followed with its own action. In early 2025, it terminated a nearly $1 billion BlackRock contract, again over the same underlying issue. Texas's permanent school fund also divested from the firm. It pulled roughly $8.5 billion in assets from BlackRock. But from the political left, the criticism was almost the exact opposite. Climate advocacy organizations argued that BlackRock's ESG commitments were largely symbolic. They pointed out that the firm still held enormous stakes in oil, gas, and coal companies. And according to these critics, BlackRock failed to use its shareholder voting power not aggressively enough to force genuine emissions reductions. So BlackRock found itself under pressure from both sides. The right accused it of doing too much. The left accused it of doing too little. Facing sustained criticism from both directions, Larry Fink addressed the controversy publicly. At the 2022 industry conference, he said he was being attacked equally by the right and the left. He added that he hoped that meant he was doing something right. But by June of 2023, Fink made another shift. He announced he would stop using the term ESG altogether in public communications. He said the acronym had become politically weaponized and that it no longer served a useful purpose. BlackRock maintained that it would still evaluate climate and governance-related financial risks, but it would do so using different terminology. Then, in January of 2025, BlackRock made an even larger symbolic move. Ahead of the change in U.S. presidential administration, it exited the Net Zero Asset Managers Initiative. That initiative was a voluntary global coalition of asset managers. Its members had committed to reaching net zero emissions targets across portfolios by 2050. BlackRock joined nearly every major U.S. bank in stepping back from similar climate coalitions, all within the same several-week period. In a letter to clients, BlackRock said its participation in the initiative had caused confusion about its practices, and unwanted legal scrutiny from state officials. At the same time, BlackRock explicitly stated something important. It said leaving the initiative would not change how client portfolios were actually managed. Climate advocacy groups strongly criticized the withdrawal. The Sierra Club was among them. They described the move as a retreat from genuine climate accountability. So the ESG controversy reveals something central about BlackRock's position. It is powerful enough to be blamed by both sides, too political for one side, not committed enough for the other, and trapped in the middle of a larger fight over what modern capitalism is supposed to serve. This retreat did not end the political and legal pressure on BlackRock. In November of 2024, Texas Attorney General Ken Paxton filed a significant antitrust lawsuit. He was eventually joined by roughly a dozen other Republican-led states. The lawsuit targeted BlackRock, Vanguard, and State Street. It was filed in federal court in the Eastern District of Texas. The lawsuit alleges something serious, and it is important to be precise here. These are unproven legal allegations, not established facts. The states claim the three firms used their combined shareholdings in major American coal producers. In some cases, they allegedly owned between 25 and 34% of individual coal companies. The lawsuit also points to their participation in climate-focused investor coalitions. It alleges they used that influence to coordinate pressure on coal companies, pressure to deliberately reduce coal production. The states argue this helped drive up energy prices for American consumers, and they claim that violated federal antitrust law. The complaint cites data showing thermal coal production fell by roughly 19%. This decline occurred between 2019 and 2022 at companies with significant ownership by these firms. During that same period, coal prices rose sharply. Then, in May of 2025, the case gained more attention. The U.S. Department of Justice and Federal Trade Commission filed a formal statement. That statement supported the legal theory behind the case. It said coordinated ESG-related investor behavior could, in principle, raise legitimate antitrust concerns. That was a notable federal endorsement of the case's basic premise. Then, in August of 2025, a federal judge in Texas issued an important ruling. He largely denied the asset manager's motion to dismiss. That allowed the core antitrust claims to move forward. But the judge also made something very clear. The states still need to prove their allegations at trial, and the case currently relies on circumstantial evidence, not direct proof of an illegal agreement. The judge described the issue as a close call. BlackRock has firmly and publicly denied the allegations. The company called the case based on an absurd theory, a theory that coal companies conspired with their shareholders to reduce coal production. State Street also rejected the lawsuit. It described the case as baseless and warned that it advances a dangerous antitrust theory. As of mid-2026, this litigation remains ongoing and unresolved. That means any claim stated as settled fact would be premature. It would be inaccurate to say BlackRock definitively did illegally suppress coal production, and it would also be inaccurate to say the allegations have been fully disproven. The honest answer is that the case is still being fought, and the facts still have to be tested in court. BlackRock's dealings with China represent another area of documented controversy. And this controversy is distinct from the domestic ESG fight. In March of 2025, a BlackRock-led investor consortium agreed to a major purchase. It agreed to buy a controlling stake in a global ports business. That business included terminals on both ends of the Panama Canal. The seller was C.K. Hutchison, a Hong Kong-based conglomerate. The deal was valued at roughly $22.8 billion. The Trump administration publicly praised the transaction. It framed the deal as part of a broader effort to reduce Chinese influence near the canal. Secretary of State Marco Rubio raised specific national security concerns during congressional testimony. His concern was about Chinese-linked entities controlling infrastructure at both ends of the canal. That canal is one of the world's most critical trade routes. But the deal quickly drew fierce criticism from Beijing. Chinese state-aligned media outlets publicly attacked C.K. Hutchison. They accused the company of spineless and unpatriotic conduct for agreeing to the sale. China's market regulator then opened a formal antitrust investigation into the transaction. That investigation effectively stalled the deal for the following year. As of early 2026, reporting indicated Chinese officials were pressuring the parties. They wanted the Chinese state-linked shipping company COSCO included in the ownership structure. That demand was reportedly being treated as a condition for allowing the deal to proceed. BlackRock and its partners were still negotiating that issue. This episode illustrates something genuinely complicated about BlackRock's global position. Some American political figures see it as too international or insufficiently patriotic. But in this specific case, the Chinese government saw something very different. It saw BlackRock as an instrument of American geopolitical strategy. That contradiction matters, because a company of BlackRock's size cannot remain politically invisible. Its deals can become financial transactions, but they can also become geopolitical events. And whether BlackRock intends it or not, its scale pulls it into great power competition. Given the intensity of criticism from multiple directions, one question deserves a direct answer. Is BlackRock a scam? That question circulates constantly online. But answering it honestly requires precision. We need to be clear about what those legal terms actually mean. A scam or fraud, in a legal sense, usually requires intentional deception. Someone must misrepresent what a product is, or what a product does, and they must do it to unlawfully obtain someone else's money. A Ponzi scheme is more specific. It requires that returns paid to earlier investors come from money contributed by newer investors, not from legitimate underlying investment activity. The structure collapses once new money stops flowing in. A criminal enterprise requires evidence of an ongoing organizational structure, one engaged in a pattern of illegal activity. Measured against those specific definitions, the answer is clear. There is no credible verified evidence that BlackRock operates as a scam. There is no credible verified evidence that it operates as a fraud. And there is no credible verified evidence that it operates as a Ponzi scheme. BlackRock is one of the most heavily regulated financial institutions in the world. It is subject to ongoing oversight from the Securities and Exchange Commission. It publicly discloses its holdings, fees, and financial results in extensive detail. Those disclosures appear in routine SEC filings. And notably, that same public data is used by both sides. It is used throughout this documentary, and it is used by BlackRock's harshest critics. BlackRock's fee structure is transparent and disclosed in advance to clients. The stocks and bonds it purchases for clients are held by independent custodians. They are not simply promised on paper. That matters, because client assets are not structurally dependent on continuous new investment to remain solvent. And that is the defining feature that would distinguish a Ponzi scheme. But this does not mean BlackRock has a spotless record. It is equally important to say something else clearly. BlackRock has faced real regulatory scrutiny and real legal consequences. Over the years, it has faced SEC enforcement actions and settlements, some involved inadequate disclosure of conflicts of interest in certain investment products. Others involved violations of rules, separating personal trading from client trading activity. The company has paid penalties in these matters, generally without admitting wrongdoing. That is standard practice in many SEC settlements across the financial industry. These documented enforcement actions matter. They represent genuine regulatory compliance failures in specific business lines. But they do not prove that BlackRock as a whole operates as a fraudulent enterprise. That distinction is essential. Massive scale is not fraud. Political influence is not fraud. Aggressive lobbying is not fraud. And public relations strategy is not fraud. BlackRock unquestionably engages in these things, and it has been legitimately criticized for them. But under established legal definitions, they are not the same thing as running a scam. The more serious question is not whether BlackRock is secretly fake. The serious question is whether it has become too large, too influential, and too deeply embedded in the financial system. That is a much harder question, and a far more important one. This distinction helps explain why so many conspiracy theories have attached themselves to BlackRock. At its core, the company largely functions as an administrator of index funds. But that structure is confusing for most ordinary people. Index funds and passive investing can feel counterintuitive, and the language used to describe BlackRock's role often makes things even more confusing. People say things like, BlackRock owns Apple, or BlackRock is the largest shareholder in Exxon. Those statements can be technically accurate in a narrow legal sense, but they obscure a much more ordinary reality. That ownership often represents millions of separate retirement accounts pooled together, not one unified strategic empire personally directing those companies. When that nuance gets flattened on social media, the story changes. It becomes one dramatic sentence. One company owns everything. That sentence is compelling, it is shareable, and it feels powerful. But it significantly overstates what shareholder registration data actually proves. At the same time, some of BlackRock's scrutiny is genuinely earned. Its role advising the Federal Reserve during two separate financial crises is real. Its aggressive and controversial ESG push under Larry Fink's leadership is real. Its enormous proxy voting power is real. And its entanglement in geopolitically sensitive deals is also real. The Panama Ports transaction is one example. These are legitimate reasons for public scrutiny. They do not require exaggeration. And they do not require fabrication. They are genuinely concerning to reasonable people across the political spectrum. The problem is that genuine controversies and exaggerated claims often get blended together online, until casual observers can no longer easily separate them. That is why a fact-based accounting matters. Verified filings should be separated from speculation. Court records should be separated from rumors, and unproven allegations should be separated from established facts. Financial economists who study asset management generally agree on a few important points. BlackRock's scale genuinely creates systemic importance. That makes it worth regulatory attention. But the vast majority of its holdings represent passive, formulaic index tracking, not active strategic empire building. Antitrust and corporate governance specialists remain divided on the common ownership question. Some view it as a serious and underappreciated competitive concern, one deserving new regulation. Others view the existing academic evidence as inconclusive or methodologically flawed. Critics of BlackRock come from very different political directions. Progressive climate advocates criticize the company. So do conservative anti-ESG state officials. They agree on almost nothing ideologically, but they share one basic concern. A company managing this much money and wielding this much voting power deserves closer scrutiny, even if their specific complaints point in opposite directions. Defenders of BlackRock make a different argument. Many mainstream financial economists emphasize the benefits of index funds. They argue these funds have helped ordinary retirement savers enormously, mainly by lowering fees compared to actively managed alternatives. They also argue that criticism of BlackRock's scale often misses a key distinction. BlackRock's own proprietary capital is limited. The much larger pool of money belongs to clients, and BlackRock administers that money on their behalf. Looking ahead, several genuine and verifiable trends will shape BlackRock's future. They will determine whether its influence keeps growing, or whether it faces meaningful new constraints. The ongoing Texas-led antitrust litigation is one major factor. Depending on the outcome at trial, it could establish significant new legal precedent, especially around how large asset managers engage with corporate governance and how they participate in shareholder coalitions going forward. The entire asset management industry is watching that case closely. Regulatory attention to the common ownership question also shows no sign of fading. Lawmakers on both sides of the aisle have introduced proposals from time to time. Some proposals aim to limit index fund voting power. Others would require greater separation between asset manager holdings, especially across competing companies in the same industry. At the same time, BlackRock has continued expanding aggressively into private markets and into alternative assets. Its 2024 acquisition of Global Infrastructure Partners is one example. Its move to acquire HPS Investment Partners is another. BlackRock has also built a rapidly growing presence in cryptocurrency products, including its iShares Bitcoin and Ethereum exchange-traded funds. By early 2026, those products collectively held tens of billions of dollars in assets. That suggests BlackRock's future growth strategy is expanding beyond traditional index funds. Increasingly, it is moving into higher fee and more actively managed territory. Meanwhile, passive low-cost investing continues to grow. It has become the default retirement savings vehicle for tens of millions of ordinary Americans. That trend virtually guarantees something important. BlackRock, Vanguard, and State Street will likely remain the largest structural shareholders across corporate America, at least for the foreseeable future, regardless of which political coalition currently holds the upper hand in the ESG debate. So what is the honest, balanced verdict on BlackRock? We need to separate what has been verified, what remains genuinely disputed, and what is simply unfounded speculation. It is verified beyond reasonable dispute that BlackRock is the largest asset manager in the world. It is also verified that it holds enormous shareholder voting power across corporate America. That power comes directly from managing index funds, funds held on behalf of tens of millions of ordinary retirement savers. It is verified that Aladdin gives BlackRock unusually deep visibility into global financial risk. And it is verified that BlackRock has played an advisory role to the Federal Reserve, a documented and sometimes controversial role, during two separate financial crises. It is also verified that BlackRock faces real political and legal challenges. Those challenges come from state governments, federal regulators, and advocacy groups across the ideological spectrum. But some questions remain genuinely disputed. They are not settled facts, they are open legal and academic questions. One question is whether common ownership across competing industries reduces market competition. Another is whether BlackRock's past ESG-related coordination crossed the line into illegal antitrust behavior. That question will likely be tested through the ongoing Texas litigation, as it continues moving through the courts. But based on available evidence and established legal definitions, one claim is not accurate. It is not accurate to call BlackRock a scam. It is not accurate to call it a fraud. And it is not accurate to call it a criminal enterprise. That does not mean BlackRock should avoid scrutiny. Its enormous scale is real. Its political influence is real. And both remain legitimate subjects for public debate. They deserve continued journalistic investigation, regulatory attention, and democratic scrutiny. The story of BlackRock is not really a story of hidden conspiracy. It is a story of modern financial architecture. A story of ordinary retirement savings pooled together, millions of individual accounts, millions of savers, all flowing through the machinery of index investing. And over time, that machinery has quietly created one of the largest concentrations of financial influence in history, largely without most individual savers ever fully realizing it.